This is the second half of a special report from Commodities Risk Analysis, the 2010 cocoa squeeze. In the first half, we discussed the events leading up to the 2010 cocoa squeeze, contracts that may exist between the fund and the dealer, and how we estimated the fund's purchase price for the cocoa futures contracts that the dealer stopped on behalf of the fund on July 15th. We explained that when delivery was completed on July 15th, the fund was long 24,000 lots of LIFFE cocoa futures contracts that expire in September 2010. The dealer was short 24,000 lots of the same contract, and the dealer held 240,000 tons of cocoa on behalf of the fund. The fund's profit was about £106 million. The profit may have been larger by a few million pounds if the fund bought and resold additional contracts before June 30th, and it may have been less by a few million pounds because of fees that it paid to the dealer for advising it. Retaining its profit depends on finding a way to resell the cocoa at satisfactory prices. Many attempts to squeeze cocoa and other commodities have caused large losses for their organizers by the time the last ton was sold. That the fund's balance sheet showed a profit on July 15th does not mean that it will show a profit next month or next year. There are 4 ways that the organizers might try to retain their profit. They might squeeze the September contract. They might retender in September. They might sell a large block of the best beans to one user. They might try to hold out until users come to them, or some combination. The first possibility is to go after even more cocoa by repeating with the September 2010 contract what was done with July. So far, there is no sign that the fund has been buying the September contract. This chart compares the September 2010 contract with the September 2009 contract in the same way that a chart in the first part compared the July 2010 and July 2009 contracts. It places every day of 2009 on the same day of 2010, April 1st, 2009 on April 1st, 2010, and so forth. Except for the 24,000 lots that the fund acquired on June 30th, open interest in September 2010 was about the same as was seen during 2009 at the same dates. Volume also was about the same until the 2 high-volume days on July 29th and 30th. There is no indication that the fund has been buying September contracts daily, as it bought July contracts during April and May. The high volumes on July 29th and 30th probably reveal other developments that we'll discuss in a moment. If the fund and dealer squeeze September, the price of the September contract will rise, and the September-December spread also will rise. Like July, both may rise by hundreds of pounds. Because 240,000 tons were tendered in July, much less will be available for tendering in September. Although there are substantial stocks in the world, the fund holds through the dealer almost 90% of the stocks that are immediately ready to be delivered. Although more stocks will be graded and made ready for delivery during August, these will be much less than were available in July. The fund can buy much less, perhaps only an additional 10,000 lots, to panic the market and drive the September contract very high. Merely holding the 24,000 lots that it already owns is not sufficient to squeeze September because the dealer is short and must tender. In a moment, we'll return to this subject. Squeezing September generates only short-term gains on the balance sheet of the fund. Eventually, it must sell its stock to retain a profit. If it moves the cocoa from a September squeeze off its balance sheet to that of the dealer by means of another swap, its balance sheet at the close of September will look very good. However, large unrealized losses are accumulating that the swap keeps off the fund's balance sheet. Repeating the squeeze increases these losses. The second possibility is to return or retender the cocoa to the LIFFE Futures Exchange in September. If this happens, the squeeze ends and large losses come onto the balance sheet of the fund. In the first part, we calculated that at July expiration, the fund showed a profit of £106 million. When the dealer took delivery, the dealer paid £2,713 per ton plus premiums and minus discounts awarded by LIFFE according to the quality of cocoa beans tendered. The premiums and discounts probably had an average value of about 0, leaving the average price at £2,713. Once July expired, the cocoa could not be retendered until September. The September contract closed on July 15th at £2,419. Retendering in September if the price had remained and were to remain at £2,419, causes a loss of £294 per ton that will appear on the fund's balance sheet when the dealer makes delivery of the cocoa. The advance from July to September will eventually cost the fund £71 million, reducing its profit to $35 million. The fund also pays £8 million in interest and storage costs while it waits for the September 2010 expiration, and it might lose even more if some of the cocoa tendered to it in July fails new grading tests. This reduces its profit to £27 million. The fund loses more money with any decline in the value of the September contract since it accepted 24,000 lots from the dealer on June 30th. In this case, the loss passes directly onto the balance sheet of the fund unless the dealer, which would be accumulating cash on the decline, reimburses the fund through another swap agreement. September has fallen in value from £2,374 on June 30th to £2,193 on August 6th, a loss of £43 million. This replaced the fund's profit with an eventual loss of £16 million. If the fund still holds 24,000 lots, and if the price of the September contract does not change from August 6th until expiration, it will eventually show a loss of £16 million. Finally, the fund probably has been paying monthly fees to the dealer since at least April for advising the fund and for handling the cocoa. Retendering already is a losing proposition. The third possibility is that the dealer sells to a user a large block of the best cocoa received in July. Rumors assert that this will happen for a block of around 100,000 tons. Among the 240,000 tons received, an end user likely will find 100,000 tons of desirable cocoa. The jump and decline in open interest on July 29th and 30th suggests that this already has happened. Open interest in September 2010 jumped by about 7,000 lots on July 29th, then fell by about 10,000 lots on July 30th. On the same days, the LIFFE exchange reported that 13,000 lots and 21,000 lots were traded against actuals, that is, were transferred from one party to another in exchange for ownership in physical cocoa. AA transactions are quite common, but rarely exceed a few thousand lots. It would be reasonable to conclude that a large block of cocoa was transferred to a user. If this happened, the fund and dealer have reduced their losses compared with merely retendering to September. After paying the £2,713 per ton for all cocoa received, and after incurring the immediate loss because cocoa must be resold against September, the dealer very likely would be able to sell the high-quality cocoa at a premium to the September futures price. Typical prices are £150 over the terminal market for cocoa from Ghana and £80 over the terminal market for cocoa from Nigeria. If the dealer sold 100,000 tons to the user at an average price of £125 over the September terminal price on July 29th, it offset and avoided some of the losses that would have been accrued by retendering. In this case, the dealer gained for the fund about £12.5 million because of the quality differential. It reduced the cost of storing the cocoa from July to September by about £2 million. After the transaction, the fund still holds 24,000 lots of September. This is very important and makes a squeeze more likely. Because the short position of the dealer in September is now less than that of the fund, their combined September futures position is now long 10,000 lots. With no further trading, except an exchange of futures for another swap, the fund and dealer will be ready to take delivery of another 100,000 tons in September. This exchange will parallel the exchange on June 30th. For brevity, we will not describe it in detail. When completed, the dealer and fund will have rolled forward to December the hedge on the 140,000 tons. Squeezing another month and rolling forward the hedges do not guarantee a profit. When September expires, it will bring another large loss onto the books of the dealer, as happened when July expired. As the cocoa is sold and the positions are unwound, the losses will be transferred to the books of the fund. However, if squeezing September lifts the price of all contracts, it may enhance the value of assets that the fund reports to its investors on September 30th. The fourth possibility is that the dealer tries to resell the cocoa to multiple end users as opportunities arise. If there are problems with the 2010-2011 crops, this might succeed. On the other hand, the high prices to which the squeeze has contributed stimulate production and depress use of cocoa beans. The fund and dealer are in a race with the consequences of their squeeze. The squeeze has caused financial distress among many firms that use the LIFFE terminal market, perhaps to the extent that some will eventually close or sell themselves to others, reducing the number of prospective buyers for the fund stocks. The fund and dealer have caused ill will such that many users will buy cocoa from the dealer only as a last resort. If 100,000 tons of the best cocoa have been sold to one user, the remaining cocoa will sell in normal circumstances at lower premiums. Selling this cocoa without new losses will be difficult. A rumor that circulated in the market on August 5th gives an example of the struggle that is emerging between the dealer and its potential customers. The rumor held that the dealer was asking 300 sterling per ton over September for good quality cocoa remaining in its stock. This is about twice the usual price for the best quality cocoa likely to be in the stock. If correct, the dealer is demanding an exceptional price that no one will pay except users that must have the cocoa immediately to keep their factories from stopping. The buyer of the first 100,000 tons probably did not pay an exceptional price because the dealer and the user recognized that the transaction was important to achieving some amount of profit from the squeeze. Carrying costs will continue to mount unless the backwardated structure changes back to a contango structure, in which the price of each contract is lower than the price of the more distant contracts. A move from backwardation to contango almost certainly would be accomplished by a decline in the price of all contracts, causing additional losses for the fund. We have completed our discussion. Unless the organizers of the squeeze have the good luck that prices rise without further action on its part, the most likely development is that they will squeeze September. All their actions lead to immediate, perhaps substantial losses on the balance sheet of the fund. Squeezing September will enable the fund to window dress its September statements, keeping many losses off its own balance sheet for another 3 months, while the dealer waits for users willing to buy the stocks at high prices. Without squeezing September, the prospects for the fund to profit are poor. Squeezing September does not guarantee profitability. It window dresses the fund's balance sheet at the end of September and rolls forward the losses to a future quarter. Regardless of the outcome for the fund, the dealer probably will profit from management fees earned along the way, provided that it kept strong clawback provisions out of the management agreement. It also will have profited from trading for its own account if the management agreement permitted such trading. For a free transcript of this presentation, send your name, company, city, and country to transcript@commoditiesrisk.com.